There's an index on Wall Street nicknamed the fear gauge. When it spikes, headlines scream panic. When it's low, analysts call it complacency. And every time the market drops, someone on financial television points to it like a thermometer proving the patient is sick. The problem is, the VIX doesn't measure fear. It never did. It measures the price of insurance. And those are two very different things. The CBOE Volatility Index, the VIX, was introduced in 1993 and overhauled in 2003 with help from Goldman Sachs. It takes the prices of a wide range of call and put options on the S&P 500, weights them by strike price and time to expiration, and spits out a single number expressed as an annualized percentage. A VIX of 15 means the options market is pricing in roughly a 15% swing in the S&P 500 over the next year. Divide that by the square root of 12 and you get the expected monthly move, about 4.3% in either direction. That's it. No sentiment survey, no poll of investors' feelings. Just the cost of hedging, distilled into a number. And here's where it gets interesting. When markets are calm, fewer people buy protection. Options get cheaper. The VIX drops. When uncertainty rises, an unexpected policy announcement, a geopolitical shock, a jobs report that rewrites the narrative, demand for options surges. Prices go up. The VIX climbs. That inverse relationship with the S&P 500 is real, and it holds roughly 78% of the time. But the other 22%? The VIX and the market move in the same direction, about 1 in every 5 trading days. That's not a glitch. That's the system telling you something the fear gauge label completely obscures. Volatility isn't directional. The VIX doesn't know whether markets are going up or down. It only knows how much the options market expects them to move. So when stocks rally hard and the VIX rises alongside them, it's not contradicting itself. It's saying the market expects big moves to continue, just maybe in either direction. In late 2024, the VIX climbed even as the S&P 500 approached record highs. The reason wasn't panic. It was that traders were buying upside call options aggressively, driving up the price of those contracts and inflating the index. The fear gauge was registering excitement, not terror. That misread matters because an entire ecosystem of financial products was built on top of the VIX, and most of them are designed, architecturally, to lose money over time. You can't buy the VIX directly. It's a calculation, not an asset. So in 2004, VIX futures launched, and from there, a wave of exchange-traded products followed. Funds that let anyone with a brokerage account trade volatility. Products like VXX, UVXY, and the now infamous XIV. The pitch was simple. Volatility spikes when markets crash, so holding volatility gives you a hedge. In theory, elegant. In practice, it's one of the most reliable wealth destruction mechanisms in modern finance. Here's why. VIX futures almost always trade above the current VIX level. This is called Contango, and it happens roughly 84% of the time. The reason is structural. Volatility is mean reverting. It spends most of its life at low levels with occasional sharp spikes. Because those spikes are short-lived, futures contracts expiring a month or two from now are priced higher than where the VIX sits today. The market is essentially charging you a premium for the possibility that something might happen before the contract expires. Now, products like VXX hold a rolling portfolio of those futures. Every day, they sell the nearest contract and buy the next one out. In Contango, that means selling low and buying high, repeatedly. The position doesn't blow up from one big hit. It takes damage over time, like a poison debuff that ticks away whether you're in combat or not. The cost of maintaining exposure erodes the principal every single day. VXX has lost more than 99.9% of its value since inception. Not because of a single crash, because of a status effect baked into its design that never expires. The inverse products worked the other way. A fund like XIV, ticker deliberately spelled as the reverse of the Roman numeral for the VIX, profited from that same Contango. It effectively collected the premium that long volatility holders were paying. For years, it was one of the most popular exploits in the market's meta. Buy XIV, watch the VIX futures curve decay in your favor, collect steady returns while everyone else grinds for alpha. The strategy worked so consistently that it attracted billions. But like any exploit that gets too popular, it had a hidden condition that could trigger a catastrophic failure state. It needed volatility to stay within a manageable range. If the VIX spiked hard enough, fast enough, the math broke. On February 5th, 2018, it broke. The VIX opened at roughly 18. By the close, it hit 37, a one-day doubling that was, at the time, unprecedented. But the closing number doesn't tell the real story. What happened in the final 50 minutes of trading was a feedback loop that would later be called Volmageddon. Here's the sequence. As the VIX climbed during the day, inverse products like XIV and SVXY lost value rapidly. These products were contractually required to rebalance at the end of each trading day. To maintain their inverse exposure after a day of losses, they had to buy VIX futures in massive quantities. That buying pushed futures prices higher, which caused more losses in the inverse products, which required more buying. It was a chain combo with no cooldown. Each hit guaranteed the next one, and every cycle amplified the damage. In the last hour of trading, VIX futures spiked nearly another 100%. Around $4 billion in VIX futures changed hands at the close. XIV went from $1.9 billion in assets to $63 million in a single session, a loss exceeding 96%. Credit Suisse triggered the fund's acceleration clause, a built-in kill switch for losses exceeding 80% in a single day. XIV was terminated. SVXY survived but was restructured with half the leverage. The trade that had minted consistent returns for years was revealed to have always contained a self-destruct sequence. What made Volmageddon instructive wasn't the size of the VIX spike. Volatility had spiked before. It was that the products built on top of the VIX created a feedback loop that amplified the move far beyond what underlying conditions warranted. The S&P 500 fell about 4% that day. A bad day, not a catastrophe. But the VIX behavior suggested a systemic crisis. The instrument meant to measure market stress became a source of market stress. That dynamic hasn't gone away. It's evolved. In April 2025, when sweeping tariff announcements hit the market, the VIX jumped from under 17 to above 60 in 8 trading sessions. The S&P 500 dropped more than 10% in 2 days, one of the sharpest declines since 1987. But here's what happened next. The VIX collapsed almost as quickly as it rose. Within weeks, it was back below 20. The market recovered and rallied more than 35% from the lows. Historically, VIX readings above 60 have been among the strongest long-term buy signals in the data. The index, designed to measure expected turbulence when pushed to extremes, has been one of the most reliable indicators that the turbulence is almost over. This is the paradox at the core of the VIX. Extreme fear, as priced by options markets, tends to be self-limiting. When the VIX spikes to 50, 60, 80, it means options are extraordinarily expensive. That expense itself dampens further selling. Hedges are already in place, protection has been bought, and the cost of panic has been fully priced in. The system hits a built-in cooldown. Meanwhile, the VIX's mean reverting nature means it almost always drifts back toward its long-term average, which sits around 19 to 20. Spikes are violent and brief. Calm is gradual and persistent. The system's default state isn't chaos. It's the slow return to equilibrium after a burst of energy. So the VIX doesn't break in the opposite direction because it's flawed. It breaks in the opposite direction because it's measuring something more subtle than most people realize. It's not tracking emotion, it's tracking the price of uncertainty. And that price follows its own supply and demand logic. When everyone has already bought protection, the price of protection falls. When nobody is hedging, it's cheap. The moments of greatest measured calm are often when risk is quietly accumulating, and the moments of greatest measured fear are often when risk has already been discharged. The long-term average disguises this. A VIX sitting at 14 or 15 looks peaceful. But in those environments, the futures curve is steeply in contango, short volatility strategies are crowded, and the cost of hedging is at its cheapest, meaning almost nobody is hedging. That's not safety. That's every player running the same build because nobody's tested the current meta. Compressed potential energy waiting for a patch. And a VIX at 40 or 50, where the curve inverts into backwardation and every portfolio manager on Earth is scrambling for puts? That's the system admitting it doesn't know what comes next, which, paradoxically, tends to mean the worst is already priced in. The VIX is a piece of market architecture that reveals how financial systems process uncertainty. It's not a fear gauge, it's a pricing engine for the unknown. And the products built on top of it don't trade volatility. They trade the structure around volatility. The curve shapes, the roll costs, the rebalancing mechanics. Understanding the VIX means understanding why that number exists, who's paying for it, and what happens when the architecture starts feeding back into itself. If this kind of breakdown changes how you think about markets, subscribe to 8-Bit Economics. Every week, we strip complex financial systems down to their core mechanics. No hype, no predictions. Just the underlying code that drives how money actually moves. Hit subscribe, drop a like if this shifted your perspective, and leave a comment with the financial system you want decoded next. By the time everyone sees it coming, the smart play is already over. Here's what stays with me about the VIX. Every major spike in its 30-plus-year history has eventually reverted. Every period of extreme calm has eventually shattered. The index doesn't predict the future. It prices the present disagreement about what the future holds. And the most dangerous moments aren't when that disagreement is loudest. They're when it goes silent. When the VIX is low, the curve is steep, and everyone agrees that nothing is going to happen. That consensus is the position. And in markets, the most crowded position is always the most fragile one. The lobby fills up, everyone picks the same loadout, and the system rebalances, violently and without warning.